First speaker is no stranger to our summit, Eric Starks. He's the chairman and CEO of Freight Transportation Research. They are the leader in transportation forecasting. What Eric does and what his company does is they take a lot of data, a lot of economic data, and they just boil it down to where it's really digestible, where we can look at that and you can look at that and make decisions, whether it's, do I need to bid freight? Do I not need to bid freight? What's the new truck builds? How does that impact me? It's really helped us in trying to, grow our business appropriately. His background in research is both in rail and truck freight movements, as well as asset equipment purchases. He's a premier industry forecaster on transportation equipment demand. So equipment demand for rail cars, commercial trucks, and trailers. So not many people bring all those modes together. He's lives in Bloomington, Indiana, which is pretty close to where my family is from originally. My parents and Tom Keller, active member in the transportation community there, as well as Knit League, and was instrumental in creating the Indiana University Transportation Board. I know Eric has taught for Indiana University in some supply chain classes. So his title is Finding Direction in an Uncertain Market. So welcome, Eric Starks.
Oh my God, thank you. It's such a delight to be here. Thank you for bringing me. I love the enthusiasm this morning. I was cracking up as he's running down. I saw the spotlight and everything. I'm like, this is great. This is fantastic. Aaron, thank you also for everything for the Keller team. It's such a great time to be here with all of you, and taking the time out of your day to kind of hang out and kind of explore what's happening within the industry. And so I don't know how you guys all feel. So I try to come up with these analogies in my head because I'm trying to figure out the world, right? And so how many of you played softball or baseball, or your kids play softball or baseball, or you coached, right? Yes, right? We're right, the baseball season is hitting its stride right now and towards the World Series. So I want you to visualize a couple scenarios, right? So it feels like right now that bases are loaded, and it's your team, and somebody's up to bat, and you walk up because you're there late for whatever reason, and the scoreboard is broken, right? And so we're staring there. What goes through our brains? What do we start doing? What do we start asking? Go ahead. This is class participation here. What do we start asking? What's the score? Yes. Okay, great. What else do we say? Who's up? What inning? Yes, what else? How many outs? What else? What? What happened? There's one more. The Aaron Judge could be up to bat. It's possible. So what's the treat? That's actually that is a big one. What's the pitch count? Right? So all these things, we intuitively just say, "Oh my gosh, we ask these questions." And it's the same exact thing with the economy. So let's stay with this scenario for just a moment. Because let me tell you, what if I communicate to you and I say, 2 outs, we're down by 3, bottom of the first inning. How do you feel? Hopeful. Yes. Are you willing to take risks? Let's say that they all of a sudden, you're now the coach. All of a sudden, you got there late, you're the coach, okay? Now, you're ready to take risks. You're like, because what happens? That risk parameter is relatively low. If it doesn't work out, you got plenty of time to fix it, right? So what happens if it's now the bottom of the 9th, 2 outs, you're down by 3? What do you do? What do? You put a pinch hitter in? Yeah. You all of a sudden are going, we're going to win this, right? It's do or die time. There's no other time left. And if we just change that scenario just slightly, so Now, you're down by 2, no outs. No, the pitch count has not even started yet. How does your thinking change? Are you willing to bunt now? Maybe, because you're going to get a run in, and then you continue to move runners into scoring position. So again, this is one of these things where the economy feels like this. It feels like we can see who's on base. But I am, for the life of me, trying to figure out what inning are we in and how many outs are there and what's the pitch count. And so that's what we're going to do today. We're going to explore that, and we're going to try to fill in those gaps because the scoreboard is broken. So I know a lot of you like to follow along and stuff. So if you want to download a copy of the presentation, you can do that. ftrnintel.com/Keller 2022, so that you can, if you'd like to continue to take notes. So let's do a frame of reference, because it's always helpful to say, here's what today's going to look like. So if we look at the basic outline for today, right? I'm going to talk about what's happening within the consumer environment, what's going on with the economy, how does that work. We're going to talk a little bit about what's going on with the ports and intermodal. How does that then start to impact trucking? What are the trucking conditions? What are the things you need to be paying attention to? And as I was kind of going through my slide deck, I'm like, man, this is loaded with a lot of stuff. So your job is not to remember everything. Your job is not to be like, oh my gosh, he talked about this, this, and this. It's the themes that come out of it, right? What are those things that we need to take away from some of this? So let's move through. Let's talk about the consumer, right? Let me ask, because I like getting some feedback a little bit. How many of you feel like we're in a recession right now? And I'm saying just feel. How many feel we're in a recession? Just a handful, right? Does this feel like 2008, 2009? Does it feel like the early 90s maybe? What is it? The feeling is so radically different than I ever recall. And so trying to put some data behind this is actually really important to be able to do that. So let's talk about consumer. Well, the consumer continues to spend. So we're looking at a couple different data points here. So I put a bunch of crap on here, and I'm like, why did I put so many lines? Basically, the top dotted lines in there is not adjusted for inflation. So the solid line, so the very top solid line, is what's happening within the service sector. And so, because services is the largest bulk of what happens within the economy. Well, when COVID hit, services went away, and they said, okay, I'm out. And finally, they're coming back. So when we adjust it for inflation, we're basically just a little bit above where we were pre-pandemic. And it's like, okay, so we're starting to feel a little bit more normal about how things were. But if we look at the goods, which is the bottom solid line, well, it dipped a little bit, and that you can see that black dot along there is pre-COVID levels. It dipped, and then it went right back up, and we continue to stay up there. It has not materially changed. It has flattened out. And so this is the billion-dollar question within this room is, does this market go down, stay flat, or go up? And right now, a lot of the stuff we're seeing suggests a flattening. So let's explore a little bit more. Let's keep moving on some of this. So if we dissect the goods, and so each of you move different things, right? If you're a shipper out there, you're doing different stuff. Well, some of your stuff may be a durable good or a non-durable good. It depends on what you're doing and where you are in the process. The top is what's happening in the non-durable market. So non-durables recovered, and they have flattened out. But we actually saw a larger recovery in the durable goods sector, which is the bottom line. So it's actually further above where we were pre-pandemic relative to the other sectors. And it's all kind of holding there. So there is demand in the system. This is all freight, right? Everything here generates freight. And so that then creates pressure points for you because you have a supply chain that you need to continue to move efficiently. Let's keep sliding along on some of this stuff. Now, so when we try to dissect it and we say, okay, great, we have the consumer going out there spending, and we can look at a couple different things. And you can see a divergence here, and the divergence on the top is what's happening with non-store sales, right? So this turning point right here in 2020, that's all me. I did all of that, right? we all did all that, right? What did we do? We all went, the pandemic hit, and we all go, no, I'm not gonna order online. I'm not gonna do it. 2 days later, you're like, okay, this, yeah, I'm fine. I'll order online. You order a couple things online. You're like, oh man, that was pretty easy. That wasn't too bad. And then the next week, all of a sudden, you're ordering a couple things a day, and then finally you just say, screw it, and you just start hitting the buttons, right? And you're like, I want it. Yep, let's go. And these things just show up to your door, and you're like, this is awesome. So that is what has happened. We have seen this change that happened overnight. And we knew systematically that it was moving in that direction, but not as swiftly as it would happen here. COVID changed how we do business. Omnichannel became the norm. I want it when I want it, how I want it, and I want to order it anytime, anyway. And that changed how we all did business. And for some of you, that was exciting. And for some of you, you're like, this is a stinking nightmare, right? Because all of a sudden, everything changed overnight. Let's keep exploring a few more things. So, how many of you worry about inflation? I'd say most of us are worried about inflation in some way. Now, if we go back and let's digest inflation. If we think about it from a transportation perspective, when did inflation start hitting transportation? Anybody? When did you start feeling transportation inflation? What was that, Barbara? Gas? Yep, gas prices. What about within your business? When did you start seeing that? 2020? Early 21? May of 2020. So something shifted, and so by the time we got in the first part of 2021, inflation for transportation was already going crazy. It took a while for that to percolate through to the consumer. And then the consumer finally hit. So what we're looking at here is the core CPI, Consumer Price Index. And we're looking at the year-over-year change. And we're seeing somewhere around that 7% range, 6 to 7% year over year. The target here is about 2 to maybe 2.5%. That's what they want to target inflation to be. So this then forces the Fed to go out and say, you know what? We need to slow inflation down. So how do they do it? Traditionally, they have gone out and they said, we're going to raise interest rates. And as we raise interest rates, that's going to slow spending. And then people are going to then say, I'm going to reset, and then it's going to pull the pricing down. Now, how many of you over the last 2 months have materially, and I use the word materially liberally, materially changed your spending behavior? Any of you? 1, 2. That's not a whole lot. That is part of the issue we're running into. COVID has changed the mindset of how we are. I might be like, God, there might be a recession looming. Screw it. We're going down to Florida. You're like, why are you going to Florida? We're just going, right? We held off for so long. And you start doing these things because it's now we feel like we have not participated in some of this stuff for so long, and we're finally getting there. And I think that's kind of what's happening right now. You're seeing where people are fighting this and saying, you know what, I'm not holding back. We're going. And so this then leads us into the Fed goes out, they raise interest rates, and then what happens to our mortgage? Well, for many of us, it does nothing. because you already have a locked-in mortgage rate. But for those going out there and buying, all of a sudden the mortgage rate goes up, and it doubles or higher. So, in fact, I haven't even updated this recently, but what are we at? In the 7% range now? It keeps bouncing between 6, 7.5%, something like that. This is creating big issues for the consumer who is saying, oh my gosh, I just want a house. But house prices were crazy. Any of you looked at your house price within the last 30 days? I always ask you this question. Last 30 days on Zillow, how many? Yep. And how did it make you feel? Pretty good, right? Because we're like, sweet, I'm rich, man. This is awesome, right? If I sold it today, I would be doing fantastic. The problem is that the ability to sell it today has become more difficult. And so the consumer of buying homes has started to say, wait a minute, I need to rethink about this. Now, and I've talked to you before about this, is that, gosh, what, in the 70s and 80s, people were paying 15, 20% on their mortgages. 6%? We almost laugh at that. We're like, that is nothing in the grand scheme of things. The problem is the swift change from going under 3 to above 6 is a mental block, and they go, oh, I have to readjust. I have to think about this now. But we don't have an oversupply of homes right now. We don't have all of this imbalance. The imbalance right now is this readjustment of, can I afford it? And what does that affordability look like? And house prices probably are a little bit too high. They probably do have to come back down. It's kind of like the stock market. It went a little bit too high and it has to normalize. And so this is one of the things that I think has some negative impacts in the short term. But it doesn't seem to materially be telling the consumer, I'm out, right? In 08, 09, housing market collapsed. We're like, I'm out. Everybody basically said, we're done. That does not seem to be the case this time. So let's talk a little bit more about the consumer. Okay, so if the consumer, we have different ways to look at how the consumer behaves or where their situation is. One way we like to look at is we like to look at the savings rate. So if we look at the savings rate as a percentage of disposable income, that is really, really low. And we go, ooh, not a whole lot of savings there. How are we going to spend? Well, part of that is how this is calculated. If we look at what's happening within the next data set for cash reserves, all of a sudden cash reserves have gone up dramatically. And so the savings rate does not tell us the full story. So the consumer has a substantial amount of cash still out there. The million-dollar question is, which consumer? Right? Does the right consumer have access to this cash? That is an unknown. The other thing that happens is if we think about how the Fed behaves and how banks behave. Right? Traditionally, when we would go open a savings rate, what did we expect to have happen? Right? You expected nothing for a checking account, right? Checking account, you get nothing for it, but you're like, I'm going to put it all into savings. And what would you expect to get for it? Give me a percent that you would expect to get on a traditional savings when you opened it. I can't hear, so go ahead, scream it. Couple percent? 3%? That seems reasonable, you know? And you're like, yeah, I'm getting a little bit of money for leaving it in the bank. Well, what traditionally has happened is the Fed raises interest rates, borrowing costs go up. Usually it's because they're having some issues of finding liquidity, all of these things. And the banks are like, I don't need any more cash. I don't need it. I'm not paying you anymore for your savings. So we, in essence, are not incentivized to save at the moment. In fact, when you have an inflation rate going up, you're almost incentivized to buy today so that you don't have the cost increase tomorrow. This is one of the issues that we're running into is there is no incentive within the system to save because of how that imbalance is there. It is not working in a traditional way that we would expect. So we look a little bit past the cash reserves, right? And we look at household debt. Well, household debt as a percent of disposable income, again, very, very low. And so the consumer actually is in a pretty good spot, relatively speaking. Again, this is a broad overview of the overall market. It doesn't do the segmentation by income levels. But by and large, the market says, again, nothing out of balance here. And if we then explore and look at what's happening next within the credit card environment, because I remember, right, credit cards were becoming the big thing when I was going through college, and you'd get a credit card for 26% or something, and you're like, sweet, I got a credit card, and then you'd go spend it, and you'd do all these stupid things, right? Well, our kids are getting savvier, right? We got the debit cards, we got all of this electronic stuff, and how they deal with debt. Well, if we look at the credit card delinquency, that is so low. Right? If we pull that up for a second, if we look at the delinquency rate, under 2%, that is phenomenal. That tells us that they're using that cash that's out there to actually pay off that debt and to continue to stay on top of this. This traditionally changes as we start heading into a recession. We usually start seeing delinquencies going up. Again, that hasn't started to happen. So I'm getting mixed signals. Sometimes I'm like, oh, we're in the 9th inning. And other times I'm like, we're still in the 5th inning. We're okay, right? This is the conundrum that we continue to deal with. Okay, let's keep moving on. Let's keep exploring more data, because I think this is helpful for you to kind of, I'm a visual learner, right? I need these visuals to help me understand where we are in the cycle. Any of you like inventories? In the past 2 years, have you liked inventories? Sure you have, because you want to make sure you have the right inventory, right? You only like inventories if it's the right inventory, right? Right time, right place. But the issue is we got to measure this. We've got to figure out, what does this look like? So if we look at inventories, so there's a couple ways for us to do this. The top line here is all inventories, all retail inventories. Right? And this is inflation adjusted already here. And what we find is that inventory levels on an absolute basis, adjusting for inflation, are right back where they were pre-pandemic levels. You're like, that's not too bad. But if we take out automotive and we look at the bottom line, now we see that inventory levels are way above those historical levels. Pre-pandemic. This is the concern that starts to percolate when we start saying, there could be some slowdown, right? Is if you're holding on too much inventory, that is problematic. But there's this conundrum, right? The Fed has just started to raise interest rates. You're getting no money on your cash reserves. So it's, in essence, better for you to hold on to inventory right now, because you're going to make more money off that inventory over time. It's this whole thing of trying to figure out, what does that look like? Okay, let's keep exploring inventories a little bit more. So if we keep moving on. Well, so the consumer, there's ways that we like to look at of measured inventory. And that's the inventory to sales ratio. So we say, here's how much inventory is sitting out there relative to the sales activity. The lower this number is, the more pressure there is in the system for freight demand, because everybody's saying, I need it tomorrow because my sales activity is so good. Well, if we look at the orange line is wholesale, right? And wholesale seems to be back kind of where it was before. The retail number is very, very low, and that's the green, relative to history. And we're going to break this apart just a little bit, because I think it's very important for you to understand where some of these problems are and where some of these opportunities are. So if we move on and start breaking this down just a little bit more, if we look at automotive, any of you gone out within the last year and tried to buy a vehicle? Were you successful in getting a brand new vehicle that you wanted? Not bad. I went out and I tried to buy one of my kids' a vehicle, and he was just getting out of. Actually, it was he had just graduated, and he was going to buy his first car, and so I'm like, great, let's go look at some stuff. So we started looking. 4-year-old, 75,000 mile vehicle, and in fact, it was even older than 4 years old. But minimum 4-year-old, if you could find it, was the same price as a brand new car. Same price. And I'm like, why? Why would I ever do this? This makes no sense. And then we kind of put it off for a month. We're like, oh, we'll wait for a month. Put it off for a month, went back out, couldn't even find the 4-year car. It was now a 6-year car for the same price, 75,000 miles on it. I'm like, he luckily found one on the lot that was a nice little starter car that was brand new. But that was not the norm. This is the issue. There is not enough inventory out there still to meet that underlying demand. So the million-dollar question that the automotive folks are asking is, did I miss out? Right? Did it pass us by and people say, I'm out. I can't do it anymore. I don't think so. I don't think that's the case. I still see pent-up demand out there for automotive. I still see that happening. But part of it, they can't produce enough. They just can't do it. Okay, let's keep on moving on through a little bit more. So I looked at the wholesale and we looked at the retail. Part of the issue is because automotive is a part of the problem there, right? So we have to look at the inventory to sales ratio without automotive, and that's the bottom line, right? That has started to come up, and we're just still below pre-pandemic levels, but we're getting close. But the wholesale number, if we look at wholesale and we take out petroleum, now we are above or right at the peak of pre-pandemic levels. And so we are seeing distortion within the data from a couple different sectors. Petroleum is a big one, and automotive is another one. So let's stick on petroleum for just a minute. Any of you paid attention to the price of diesel this week? What happened this week? It went up, right? Depending on where you're looking, it went up 50 cents, it went up a buck. There's all these things. And I was really kind of shocked when I was driving the other day, and I went from one town to the next, and the price jumped $1. It's just that they hadn't gotten it percolated down to that area yet to change that price. But I was like, holy cow. So this then brings us to the whole geopolitical environment, right? So we can't have a discussion about the economy without talking about Ukraine and Russia. Just can't do it. So early on, when everything was happening early in the year, I was really, really concerned about the U.S. getting pulled into a war, all of this disruption. I am still worried about it. It has lessened because it shows that some of those fears have mitigated in some respect, that we haven't gotten pulled in. But the underlying issues have not changed. The underlying issues that impact us over here, and I'm not trying to be glib about this. This is trying to just look at it from the economic standpoint of this. So fuel prices will continue to stay high because Russia has basically said, I'm going to continue to use natural gas as a bargaining chip. And also the global markets have said, we don't want their natural gas and we don't want their crude. So that creates a pricing point that we're like, I don't know, how does this work? The likelihood that we see a reduction in fuel prices is relatively low. But we were seeing it. And I was sitting there going, scratching my head. It's starting to come down. And then what happens? OPEC goes, yeah, we're gonna reduce our output. So then the price goes bloop, right back up. So this, from an inflationary standpoint, is huge. The other part of that too is food. We continue to be very concerned about the food situation in that Ukraine region and Russia. A huge amount of wheat comes out of there, but also a significant amount of fertilizer comes out of that particular region. So this potentially has some longer-term impacts on food supply that we can't fully model to say, here's the impact. But what it does is it creates downside risk. Let's talk briefly then about domestic, on the domestic front. So one of the things that we had anticipated is that because of all the stuff that was happening with Ukraine, all the stuff that was happening with pricing, is that the Biden administration was going to get put into a bind, and they have been. They've been totally put in a bind. And so how do they juggle this? And I had hypothesized and said, you know what? They are going to need to figure out how to incentivize domestic production. They'll do that by releasing the Strategic Petroleum Reserve. They have done that. They are depleting that. And so that is giving them a backdoor way to kind of have those discussions to say we need to kind of replace some of that. Again, not saying good, bad, or indifferent. I'm just saying this is what I anticipate is going to continue to happen. They are going to have to come up with some solutions, at least for the next 5 to 10 years, to increase output levels. We cannot rely on Saudi Arabia, for example. I mean, that's not even fair. It's still consumption. So it doesn't really matter from my standpoint. But they are going to have to figure out how. Also, I anticipated they were going to start releasing some land, and they did. They started doing that. So I think it's starting to percolate. We just haven't seen it move through in actual production. So I anticipate that by the end of the year and first part of next year, you'll actually see increases of domestic output levels. But I guarantee you, many in that, specifically in that arena, are going to try to downplay that. But what we don't know is, will it have a material impact on pricing? That I don't know. Okay, so let's keep working through this. So, you know what? This is a terrible slide. Way too much stuff. Let's keep moving on. So, too much to digest. Like, we talked through all of it. So the one thing, though, that has been interesting is if we look at some of the segmentations, that's all that was really looking at. And food is one that actually is about the only one that actually seems to have the right mix from a inventory supply standpoint. But the other one is the other category, right? This includes non-store sales purchasing, right? That right now is relatively low. But you know what? I am going to go back one. Let's go back one. Right? So the top middle is clothing stores. How many of you have actually been into a clothing store in the last month? Pretty good. I'm impressed. Those are starting to go away, right? We tend to be more oriented towards department stores and to online sales. So that disconnect is there. So move forward again, then we're seeing that those inventories for primarily the non-store sales are relatively low. Okay, let's get moving on. Let's keep going. So I've showed negatives, I've showed positives, I've showed all this stuff. So underlying are some fundamentals. In general, we believe the consumer is going to soften somewhat in the sense of saying, I'm not going to continue that growth trajectory. Just not going to happen. But I'm not going to stop either. So that growth trajectory starts to ease. But what about businesses? Businesses continue to keep ordering. And if we look at, this is the core capital goods orders. So this is a great proxy for what businesses are likely to do. I'm only looking at the line here. The line continues to go up. They keep ordering and ordering and ordering, and that has not hit a peak yet. Now, the other thing then is recently, so manufacturing output has been at decent levels. We're seeing order activity, and traditionally, when we get into recession environment, trucking feels it pretty well. And they say, you know what? I'm not going to order equipment. I'm going to wait. I'm going to see about capacity. I'm going to do all of this stuff. Anybody pay attention to the news, what happened for September truck orders? Record levels. Record levels ever. So I'm sitting here scratching my head. Okay, why are truckers ordering all these trucks? You order a truck if you have freight to move. You have to replace that equipment. All of these things are happening. So it's not just trucking. It's all businesses are dealing with this. So let's talk about the ports. How many of you have to deal with ports in some capacity? Anybody? Great. Perfect. This is good. So, okay, keep moving on here. If we look at what's happening within North America, and so in this case, we're going to just look at the intermodal, the container box. So this is the number of TEUs, 20-foot equivalent units. And so we're going to split it into imports and exports. Well, what we find is that the imports continue to keep growing, but the exports have been on a downward trend. Well, this was already happening before we went into the pandemic. The pandemic didn't help that. And then what's been happening recently? What's going on with the dollar? Got a strong dollar. Well, strong dollar and basically incentivizes less exports, more imports. And that's actually what's been happening, but it hasn't, that trend has not fundamentally changed. That change is there. We're seeing more imports, less exports. But if we start looking at it by port region, if we look at what's happening with West Coast port, that underlying trend is still there. Even though we saw things crazy tight, that has not materially changed how much freight is going in and out of this particular region. If we look at just the bubbles, the bubble continues to keep getting bigger. And so this structural issue is one that impacts freight, because if you bring it into the West Coast, what do you have to do? You either have to get it onto the railroad, and you have to then move it intact all the way in. Nobody wants that, especially the ship lines, because they want that container back. Or you have to then get it to a transload facility, get it into a domestic box, and then decide, do I put it on a truck or do I put it onto the rail? And there's some complications there. What are some of the complications? Chassis. Finding chassis is still difficult. That has not materially changed. Finding warehouse space continues to be very difficult. Finding workers to work those warehouses continues to be significantly difficult. And then, if you want to move it on rail, getting the railroads to actually get it from those locations and get it actually onto the rail. All of these problems are still there, even though some of the ships are not backlogged like they were before sitting out there. So this moves us into then the East Coast. So if we look at the East Coast, this is where the change is happening. And we're seeing large increases in import activity relative to the export activity. What happens when we bring it into New York, New Jersey? How does that move from there? Is it a rail move or a truck move after that typically? It's a truck move. So that eats up capacity. And not only that, but then you need a chassis for it. So now you have to relocate chassis or say, I need more chassis here. It changes that dynamic. The other area then is in the Gulf Coast. So if we look at the Gulf Coast, so what we're finding is the imports continue to outpace the exports. Traditionally in the Gulf, if you brought something in, you brought something out. That's how it was. That has started to change. So this is primarily coming into Houston. So now they're starting to redistribute stuff. And so things then move up into Dallas, kind of like what Brian was talking about. It's a big area. You start moving stuff into Dallas, and you continue to keep moving off from there. We've seen Walmart put in a big center there, all of those kind of things. That is an area where there has been some growth. And so one of the hypotheses is that we initially said early on is we said, you know what? If people are leaving the West Coast into the East Coast or the Gulf Coast, they'll come back to the West Coast. But the data doesn't bear that out. If we look at the market share data, what we see is that the West Coast has been on this downward trend, that's that dotted blue line, from a market share perspective, for an extended period of time. And the Gulf and the East Coast has been on an upward trend. So the likelihood that we go back to where we were is probably relatively low. And so some of these shifts are somewhat permanent. That doesn't mean that the West Coast is going to see a drop in the amount of freight. It just says as a proportion of freight coming in, you're going to see more of it moving into the East and the Gulf Coast. This changes how freight moves then. This changes how much trucking you need, how much rail you need, and that overall infrastructure. How many of you felt like we've been in the traditional shipping season actually occurred this year? Anybody? Do you have a traditional shipping season? Yeah? Did it happen the way you thought it was going to happen? Ryan, how about you? He says yes. Yeah. Different people have seen it different ways. And so what we have to do is we have to try to dissect this to say, did it actually occur? So if we look at the data that's out there, what we see is that there is a normal seasonal behavior. So the dotted line is what we would expect this year to have been based upon normal seasonal behavior. And this is the number of intermodal loaded TEUs coming into the ports. This is what we would have expected. Well, what happened? We had actual numbers significantly higher in the first half of the year. Well, we saw people bringing more and more stuff in earlier than normal. And so it said, okay, this traditional pattern has kind of gone by the wayside. But now that we are into, actually the latest data is through August here, we are right at our expectation. So we didn't see the seasonal surge. That's because the surge happened earlier on. So we are right where we would have expected us to be. And in fact, all things being equal, we're above where we would have expected to be for the full year. So demand has been relatively robust in this particular market, even though the traditional shipping season kind of pattern changed for some people because of that. Okay, so intermodal. Let's talk just briefly on intermodal. I want to make sure we have plenty of time for Q&A. But if we break out the equipment, right? So there's different ways to look at intermodal. And we kind of say, what about the international equipment, right? Are you bringing in the 40-foot, 20-foot boxes by the rail, or are you doing it for domestic? Well, the pricing can have a big difference depending on what you're doing. But by and large, if we look at pricing, the competitive index for intermodal, that has an impact. And anytime we put all the metrics in, we say what's happening with capacity, what's going on with the truck environment, what's going on with rates, all of that, we can say, is intermodal favorable or not? Should you be looking at intermodal? Well, right now, we're in a negative territory. And that suggests that intermodal is not very favorable, that actually moving stuff by truck is going to be a more attractive thing here. As we move into 23, that continues. It's not until we get in the latter part of 23 that we finally start to get into positive territory where now intermodal starts to become more competitive with specifically truck. And so from a shipper's perspective, this has an impact because it says, how should I be structuring, especially if I'm looking at some things of, do I need to be shifting? This basically says status quo is okay. I don't need to be looking at that shift. In fact, actually, I could be looking at more trucking than intermodal on that. So I keep moving forward. But on the pricing side, pricing continues to be relatively high. We have seen pricing coming down. So the line is an index, and it's absolute level. And then the bar is the year over year. We'll get 2 year-over-year negative numbers as we move into the early part of 23. But it still continues to be very, very high from a pricing standpoint. It has not come down or replicated what we've seen specifically, say, in the spot market. Okay, let's keep on going. Okay. Let's keep going. I got plenty to keep going. You guys can have a copy of these slides. We'll move on into the trucking conditions. So we've covered all the main themes that we needed to hit. So if we now look at the data for trucking, so 2 things that we're looking at here for the next few slides. The blue line is absolute loads in total. The green line is the loads that are getting posted on the truckstop.com load board. So that tells us how much freight is getting posted into the spot market. So we're using that as a spot proxy. And what we're finding is that the number of loads continue to be relatively healthy in total, but people are starting to flee the spot market. And they're saying, I'm out, right? I don't need to be doing that. I'm going to work with my contract carriers. I'm going to basically be resegmenting how that looks. And so that's been happening within the dry market. If we look at the refrigerated market, same exact thing is happening within the refrigerated market, right? It went up, and now it's come down. There's been the divergence. This is relatively normal as we start having cycle corrections. But where things are not normal is in the flatbed market. If we look at the flatbed segment, we have seen noticeable weakness in that particular segment. But the pricing continues to be very, very high. And we cannot explain it for the life of us. And so we know that demand has shifted because you have a couple different core things. One, you have oil fields is a big one. You have big box stores is another, just raw manufacturing, pipe, metal, lumber, all of that stuff is there. And so those different segments have been intersecting. And so that has come down recently. Okay, driver hiring. Let's talk just a little bit about driver hiring for a minute. Because we hear about driver shortages all the time. We say, oh my gosh, what's going on in the world? Well, what we want to understand is, are market conditions changing? And if we look at what's going on with driver hiring, we go and we ping the drug and alcohol database. We say, how many are doing a pre-employment query? Because if they're doing a pre-employment query, then typically it's saying, I'm looking at hiring somebody. That has not slowed down. So it tells us that the hiring activity continues to be relatively robust. We would expect that to start turning a little bit once everybody says, you know what, I don't need as much as I thought I needed. A couple other things to look at from driver hiring is we saw recently net revocations, those who are losing their operating authority, has gone up noticeably. And that really has not materially slowed down. So those primarily 1, 2, 3 truck operations are starting to finally get out. But they got in at a time where pricing for equipment was high, but they could make a lot of money in the spot market. That has dried up. And so there is now this shift of saying, you know what? I don't want to be out there on my own. I need to transfer my capacity someplace else. And we're seeing more of a shift into the larger carriers instead of a traditional owner-operator environment. Okay, so the other thing is not only just net revocations, but how many are actually getting authority? How many are saying, you know what, I want to be a trucking company? Well, that number has started to finally come down, but it's still high. And so this is one of these things you're like, if people are saying I want out and others are saying I want in, how do we reconcile that? I can't reconcile it all the way, but there are a couple things that have been happening. If we look at what's happening within California, California has had their issues with AB5. Basically, the whole concept of saying, you know, do you need to be a company driver or not? And what we found is that of new trucking firms, California has started to pick up again. That big jump early on was when AB5 was initially introduced and said it was supposed to happen. Then it kind of went away, and then we're back into reintroducing it again and saying this is now what's going to happen. So we're actually seeing that California is taking a bigger share of that particular pie. Okay, let's. What about freight? Right, so I've synthesized all this stuff before. Said, okay, this is kind of how we're kind of seeing the world. But how do we then take it and put it into something that makes sense for us? And freight is a great one to do that. So this is loads originated. So what we have found is that we are above pre-pandemic levels. And right now, all things being equal, we expect we're going to kind of just flatten out for the next several months before some incremental growth as we go into early 2023. That's a big deal because all of us have different opinions. And I can tell you, and we have really different opinions even within the industry and even internally on some stuff. Some people are like, you know what? A recession is 50% likely. And you know what? I'm like, I can live with that in the sense of I agree with that 50% likelihood. What we don't agree on is the severity. Right? What's the severity look like? And others are, and that what we're saying is that the severity in the transportation sector is relatively low. But you'll have others who argue and say, you know what? It's very, very high. And this is the stuff that you guys are hearing every day and trying to make sense of. And so we can do is we can lay out the framework to say, here's how we're processing all of this and what is a likely scenario as we see it. And right now, the likely scenario is a relatively flat market. Any of you feel like you're now just able to breathe again? I do. I'm like, this is kind of nice. You're like, oh, I'm supposed to be able to breathe? This is great. This is normal, right? We were running so hard, so fast that we were always out of breath. And so now things are starting to normalize, and I think we get to a spot where this now becomes more sustainable. Okay, so if we look at capacity, because capacity has a huge impact on your business. If you cannot get a truck or a trailer at your facility, is that a good thing? No, right? You need it when you need it. So having that capacity is a big deal. So as we moved in to 21, what happened to capacity, right? The amount of seated trucks, we were basically at about 100%. If a driver was in a truck, it was moving freight, period. But what's normal? Normal for the industry is about 91%. So you always have some type of a buffer there. And people are like, I'm not used to that. So this gets us back to normalcy. But when we try to understand pressure in the system, well, traditionally, when this number is above that historical norm, there's more pressure in the system for price increases. Once we get below it, then there's pressure to reduce prices. And so this kind of becomes a pressure gauge where, in essence, we have neutrality for the moment. This is why we feel like we can start to breathe, and we're not overly concerned about some of these things. So if we talk, then let's keep moving just a tad bit more, and we'll finish up here so we have some Q&A. But if we look at the rate environment in total, we split it out and we look at the spot market and we look at the contract market. This is year-over-year data that we're looking at. Spot market has already been on a downward tear. No surprise there. But the contract market continues to be holding up fairly well. As we move into 2023, we'll see a little bit of reduction in the contract market. But we don't see a huge decrease. But the swings have been so large over the last 2 years that it's really hard to get a true gauge of what that ultimate meaning is. Because for many of you, you're like, as you move into 2023, you still want capacity, right? It's not about the ultimate cost savings. It's about, can I continue to maintain my facilities? And I think in general, that is the basic mindset for most people right now. They're saying status quo is okay. I'm going to maintain, and I want to make sure that I have access to that. So finally, let's reefer, same exact look. The dry van the flatbed is the other one. Let's go to flatbed. This looks very similar to the other ones, but the downward pressure is higher for some of this. So the flatbed continues to be somewhat problematic in that arena. Okay, I think that's the last end of my slides. Is that the last one? Yeah, Josiah, you're the best. So we have some time for Q&A. So Aaron, are you the man?
Yes.
Nice.
I thought I was. Can you hear me okay? There we go.
Yes.
All right, we've got 6 questions here, Eric. So the first one is the distribution network changing again, i.e. shorter length of haul final mile?
So it's unclear if it's changing again. It definitely had some change. My general sense is that you're going to continue to see more push towards shorter length of haul, final mile issues in general, but you still have to get stuff from point A to point B. And that's the issue, that's the big issue, because even if let's say that you're going from California to New York, you still have to get it from California to New York. Do you do it in smaller buckets so you can get your driver home at night? Probably, right? You start doing some drop and hook, live load stuff, all of these kind of things that keep efficiency moving. But to the last mile stuff, that will continue, because by golly, I'm going to be there. I'm going to need that last mile delivery. And so that shift has already happened. We've actually seen it. If we look at delivery drivers, man, they just keep hiring, and that's clearly a shift that has happened, and there's been no material change there.
Great. Second question, should we be worried about a real production cut from OPEC?
Should we be worried about it? Yes, in the sense of, and here's the thing, it's not about the output levels. It's about the pricing point that it impacts, because if it keeps inflation relatively high, right? All of a sudden, when we've already seen that, we've seen fuel prices move up. If it keeps those elevated, then that forces the Fed to continue to be more proactive in moving. So, yes, I think it is definitely something we have to be concerned about, because it's going to have that impact. But it's not just OPEC, right? It's the whole global markets right now of the petroleum markets that I think we just have to really try to better understand.
Next question, how is labor participation progressing in 2022? And what is your outlook for the labor markets in 2023?
Great question, because I didn't bring up labor, and I was kicking myself for not having done that. So labor market. So ways to measure it, right? We look at participation rate. Participation says how many people are out there of working age that can work versus that are actually out there working. And so it's roughly in that just a little bit above 62% is where it has been sitting. We would like to see it get closer up to that 63, 64%, but that's probably unlikely to occur. There has been a systematic change, and I believe you guys have a session this afternoon that's going to talk about some of this, that COVID changed all of that. And so a couple things happened. One, we have baby boomers who finally said, I'm out. We've had those that are right on that cusp have said, I'm out. But the discussion about lifestyle, and I think people are so sick of hearing this, but it has so much to do with what we're doing. Lifestyle is a big deal. Our kids are all about lifestyle. What does that quality of life look like for us? And we're finding that COVID basically said, oh, I'm okay with X amount of money. I'm okay with this. I can make it on a single household income. I can do all these things. Now, might that change over time? It might. But there is something fundamental now that people have said, I'm okay with this change. I was talking to a group the other night here, and I was like, how many of us expected that, say, a Walmart or a Meijer or something that was a 24-hour store would all of a sudden now shut down at night? We never thought that would happen. Is that now permanent? Possible. It's possible. We have now all re-level set in how that works. But we also have on the labor market the issue of trying to find labor and how much you pay them and all of that. And everybody in here, I guarantee you, is having labor issues. And that creates problems. There's way too many open jobs relative to the people that are available to take those jobs. Okay, I know he's and that hook is coming. Boom. He might tackle me. I think that would be fun. I'm up for a wrestling match, Brian. You ready? Yeah. Let's go.
All right. Looking forward with structural cost increase for truckload carriers, what percentage increase in cost will carriers settle in at 2023 versus 2020? So
this is cost versus rate issues, and We're trying to measure more of the rate and pressure environment. I don't have a good sense specifically on the cost structure, but in general, we know that the cost structure is going to continue to remain high. We don't see that coming down. Again, labor is a big one. Trying to find maintenance workers and drivers, just everything has been a nightmare, and so I just don't see costs coming down. So I don't have a good sense of what that number is, but don't expect it to ease. Sorry.
What should shippers budget for 2023 compared to 2022?
Oh, what should they budget? So, I mean, it's trying to decide on what your strategy is. And we had a good discussion yesterday on strategy, right? What is your strategic goal from your organization, right? Is it to cut costs? Is it to secure capacity? Is it to keep your things operating? You have to kind of decide what does that look like. But I think in general, you should expect at least cost increases that are 3%. In that ballpark for the contract market, for some of that, if you're doing that stuff now. But by the time we get to the end of next year, we expect that those will be down probably about 3%. So you have this give and take environment. If you want to push for pricing reduction, you can do that. And I guarantee you could probably get some really hefty pricing off of what you're doing. But it comes at a potential cost, and that's ultimately where it's hard to say what that looks like for next year.
How many years will it take for carriers to catch up and get back to normal trade cycles for trucks and trailers? Will parts shortages get better anytime soon?
Yeah, so it's probably a 3 to 5 year fix for the trade cycle. Parts are starting to become more readily available, but there's still problems there. If we look at output and production for heavy trucks, they've been at pretty decent levels, but they really can't get past the threshold. And so some of that is parts, some of that is labor, and it's just a mixture. But there still continues to be part shortages in general. I mean, you guys are probably all feeling the same stuff that I feel. I ordered a bolt the other day, and I should have had it in stock, and it's still 2 weeks and they don't have a bolt. So it's those kind of things that kill you, because you might have the engine, but if you don't have a bolt to keep it attached to your truck, then you're in your problems. So it's those kind of things.
All right,
Yeah.
last question. With trying to increase domestic oil production, is there any new talk about the Keystone Pipeline project?
No. I mean, the Keystone is a namesake issue. I think there's more discussion just in general about how things move and flow. So there will be more pipeline construction and building, but it will continue to be in line with where output levels are on that. So, but it's been a non-issue, at least from our standpoint. It has had zero impact on pricing or the output levels. Cool. I've killed an extra 2 minutes. Thank you.
Thank you so much, Eric.
Thank you all. You guys are great.
Thank you, Eric.
You rock, baby.